Hi, so let's finish the deep dive company analysis of Markel. In part 1, I went through how I firstly research a company and where I find the information. I also started working through my investing checklist. I covered the industry related questions. In part 2, I went through the competitive analysis or the moat questions and looked at the historical growth and performance of the company. And then in part 3, we looked over how the management were performing and whether management had shareholders' best interests in mind. And finally, today we create the investing thesis and we value the company. Okay, for those of you who are new, watching these videos in order is probably a good idea. But if you feel like starting here, then that's cool too. This is probably the most interesting part for most people. The checklist that I have worked through is something that is evolving and will continue to evolve throughout my career. I base a lot of my knowledge on the great investors, Peter Lynch, Warren Buffett, Charlie Munger, Monish Pabrai, Phil Town, and even a handful of others. And the company that I've been examining in detail is Markel, which has been described as a mini Berkshire Hathaway. And this video will give you the thesis and the valuation of Markel, and my previous videos will show you how I reached this point. Okay, so I've studied the company and answered all the questions so far in my checklist. I looked at the industry, the competition, the growth, the debt, and the management. Now I want to write my thesis for investing in this company. Now I'm only writing this thesis because I think it is a great company and something I'm very interested in investing in. If I thought there were too many red flags while going through this checklist, I wouldn't bother writing the thesis at all. And also I'm excited to value the company and see what price I'd be willing to pay. All right, so here it is. Here is my thesis. Markel is a very disciplined niche insurance company that has been profitable in providing a growing cash stream for Tom Gaynor, who's the CEO, to invest. I think this is an opportunity to invest in a company that can grow like Berkshire Hathaway has grown over the past 50 years. It has proven to be a compounder, as we can tell by looking at the growth in book value over the past 2 decades. The specialty insurance industry has been important for hundreds of years and will continue to be important into the future. I really like how there are incentives for Markel employees to write profitable insurance contracts, not just contracts that bring in revenue or new customers. Now this serves the insurance side of the business well and shows good discipline to turn away unprofitable business. I also really like how Markel invests the flows into stocks. Let's look at the top 10 stocks Markel currently has invested. He has Berkshire Hathaway as number 1 and 2 spots that makes over 11% of the entire portfolio. Tom Gaynor is a big follower of Warren Buffett, and I love that he has such a sizable investment in Berkshire. Berkshire is one of my favorite companies. Number 3 on this list is Amazon, which I love as well. Google and Visa are in the top 10, which are fantastic companies that I've studied before. So I can see that Tom Gaynor has a similar investment philosophy to me. Our investment values look aligned. Now, growth has been very solid over a long period of time. Debt is fine, and management is what I am probably most impressed about. Tom Gaynor himself personally has so much invested into the company that the performance of the company is tied to his overall wealth. Shareholders and the CEO are definitely on the same team. Now, I also like that he has been with the company since 1990. He isn't going anywhere, and as he has been doing so well, he talks about Markel like it's his baby. The entire Markel company thinks long-term, and that's exactly what I want in an investment. They are following the Berkshire model by having a profitable insurance business that feeds the investing business into stocks and complete ownership or in some other businesses as well. This is pretty much the exact same model as Berkshire Hathaway. Markel is only about a 13-14 billion market cap size company, and although that is above my desired $10 billion number, well, it is following in Berkshire's footprints. I could see the company growing to the size of Berkshire one day. Berkshire Hathaway, by the way, is currently over $500 billion. And that might take a few decades, but Berkshire did it. Why can't Markel? In summary, the thesis is this: long-term, owner-friendly managers, profitable conservative insurance operations, superior investing results, massive long-term potential share price appreciation, a potential 100 bagger. Markel is a compounding machine and should be able to continue to replicate this formula for years into the future. Okay, it's all very positive so far. Now we have to think of everything that can go wrong. Luckily, in some of the write-ups I've read, there are some negative thoughts. Just Google problems with investing in and then the company name if you're looking for problems in a company you're investigating, and you'll easily find negative things about that company. This is what I have done for Markel, and well, 2 of these I actually thought of myself. The first area of concern is, can Markel generate the big returns going forward? The last 10 years for stocks have been really good. Can that trend continue? Well, probably not. When we look at the Buffett indicator, we see that the stock market is overvalued. So subpar returns are more likely than above average returns over the next decade. Markel's investments might not do as well as they have done up to this point. If a reasonable crash was to occur, well, book value for Markel will be affected as about 65% of the assets are in stocks. If book value goes down, well, the share price probably goes with it. Number 2, I think they don't have enough cash in the bank at the moment to take advantage of the opportunities that a crisis might present. Number 3, well, artificial intelligence insurance products potentially take away insurance business from Markel in the future. So now it's time to try to answer those bear thesis points, and I'm pretty confident I can do this. So the strategy I learned from Phil Town, and it's actually kind of fun to pull apart the bear thesis that I just made. Okay, so here's my rebuttal. For the first point, Tom Gaynor invests in quality companies that I myself have invested in and have analyzed before. I think that companies can comfortably withstand a market correction and will be just a short-term issue in an otherwise strong compounding business. Okay, now my rebuttal for point number 2. The cash pile is building up over the past few quarters, from $2.5 billion to over $5 billion today. If the business can continue to build this cash pile, they will be ready to jump into bargain stocks. If they can be ready, a market downturn will affect their book value, but they will be buying such great bargains that the company will be far more valuable over the longer term. And that's what I want, long-term potential. Okay, my rebuttal to point number 3. Now, I can't predict AI's role in the insurance world, but I assume it will affect the entire industry at some stage. I think we are still quite a while away from seeing that, and specialty insurance will be the most difficult to challenge. The other areas of insurance will get affected first. Now, this is just going to be something that I have to monitor. And to counter this, Markel is investing in other businesses that produce free cash flow. So if they can transition away from being reliant on the float for cash flow and diversify their free cash flow streams, then that will be a positive development. Something that I'm going to have to monitor. Okay, so that was my thesis plus my bear thesis and then my arguments against my bear thesis. My thoughts now are that I really like this company. It's the type of company I would love to own myself, and I am on board with just about everything the company is doing. Okay, so my conclusion is I want to invest. But what is the company worth? We need to value the company and compare that to the current share price. So valuing an insurance company in its simplest way is to look at the price to book value and compare that to its long-term average price to book value. Price to book value is just the stock price divided by the book value. And book value is what the business is worth today if you sold everything. If the price to book ratio is above a 1, you wouldn't get all your money back if the company stopped today. If it was below a 1, then you would actually get more back if it stopped. Now, it's not a great measure for growth companies, but it's not bad for insurance companies, generally speaking. At least it will give us some sort of ballpark figure. Now, this graph goes back about 13 years prior to the GFC in 2008. The highest it has reached is a 1.8 and the lowest is about a 1.05. So I think for such a good company, I would think that a fair value would be about a 1.5 price to book value. Now, I'm looking at this in January 2021, and the price to book at the moment is about a 1.24. So if the fair value is 1.5 price to book, that would be a share price of $1,250. Therefore, buying at about $1,000 would give us about a 20-25% margin of safety. That's not bad, but I like a bigger margin of safety. I would like to try and get 50% if possible. I think I would take even 30% for such a good company. So at $875, that would be a 30% margin of safety and a price to book of about a 1.05. That would be at its decade lows. So if I wanted a 20% margin of safety, it's about $1,000. 30% is $875, and a big 50% margin of safety, that would be all the way down at $625. Now let's take a look at the discounted cash flow method. I like this method a lot because we can factor in the growth. Now, I have a slightly updated version of my calculator, so if you haven't got this new, better version, please get it from the link in the description. Okay, so here are the numbers using a trailing 12-month free cash flow number. Now, I don't love this as I think 2020 free cash flow looks like a bit of an outlier. But with my goal of 20% return on investment, I can buy up to $1,600. But I am using 10% as my growth rates, so that was at the lower end of my long-term range. I think we should be more conservative and use an average free cash flow number. Okay, now this one is a bit more conservative. This is where I've used a more average free cash flow number, and I still use the 10% growth rates. Now it's saying that it's about a $1,200 number would be a good buy price. Okay, now let's be a little bit more positive. Let's keep the free cash flow the same, but let's increase the growth rates to 15%. That is still below the 30-year average of the company. And as you can see, we're back at $1,600 again. So we had a buy price of $1,600 with the last 12 months free cash flow and a 10% growth rate. Then we found $1,200 as the buy price with an average free cash flow and still that 10% growth. Then we're back to $1,600 again with just using the average free cash flow, but a 15% growth rate. But I'm a conservative person and I prefer that $1,200 as it's the lower of all these variations. We had the price to book method giving us 20% margin of safety as $1,000, the 30% margin of safety at $875, 50% margin of safety at $625, and the DCF method giving us a value of $1,200. So I think these valuation methods work pretty well. It's given me a good ballpark to work in. So a good buy price is probably under $1,200 and even better if I can get it below $1,000. Okay, so I have my price ranges. Now I need to decide how much I want to invest. Now this isn't easy to work out. My feeling at the moment is that I should be aggressive if I get really good prices. So of my available cash that I have, I'm going to initially invest about 10% of it at $1,000. That's a good amount for me. Now, you might be wondering how I decided that. Well, let me try and explain. See, I want to have around 5 to 15 investments in total, but they don't have to be all the same size. What I like to do is buy into an investment at my first buy price with a decent amount. For me, 10% of my available cash is a good amount. I'm trying to keep a good amount of cash ready for a crisis. I really want to go bargain shopping when the opportunity comes. Now, I think this is different to trying to time the market. What I'm really doing is setting the value of the companies that I like, my buy prices, and I'm just waiting for those buy prices to happen. Maybe it isn't in a crisis, but maybe just something dramatic happens to that particular company and I get the buy prices I want. That's what I'm doing, not trying to time the market. So the plan will be that I want to go a lot bigger if I see a price under $900, and then I'll even be more aggressive again if I get $800. But I just want to make sure I have the ammo to buy if I get these prices. I'm actually working really hard at the moment to build up my cash reserves as I want to be ready when I get amazing prices. So at $1,000, I actually already have an order in to buy with 10% of my available cash. I want to then be planning to buy at $900 with 20% of my available cash, and then with 60% of my available cash at $800. That's that really aggressive buy point. Now, what happens with this strategy is that some companies I get to buy the first allocation, and that's it. Sometimes that sucks, because I want more. But luckily there are a handful of companies that I'm watching and waiting for, and eventually another one will fall into my buy zone. Okay, so we did it. We started at no knowledge of this company and went through all the checklist steps. I read up on it by reading other people's reports, and I watched a handful of YouTube videos with the CEO speaking. I made sure I didn't uncover any red flags by answering all of my checklist questions. Then what I did is I created a thesis and then a bear thesis as well, just so I knew the risks. I then valued the company and planned my buying strategy. So selling is actually really tricky. I'll save the details of selling for another video, but essentially each year, I'll check to see if the thesis I wrote is still the same as reality. I'll check my bear thesis to see if any of those things are happening as well. Otherwise, my plan is to just let this thing compound away and just don't touch it. So I hope I don't sell it until I'm super old and it's worth like $1 billion. And if it is doing that well, I'll be able to sell little bits of it over the decades to have some fun with. Maybe build my house, go heli skiing, give my future children a good education. So I did all of this work over about 10 to 15 hours spread out over about 2 weeks. That's an amazing return on time invested if this thing just keeps doing what it has already been doing for decades. I really hope you got something out of this little video series, and I think the biggest takeaway would be to just make a checklist yourself. Also, put some effort into your investments. That little bit of effort could reward you more than you possibly know. Just ask the investors of Berkshire Hathaway 30 years ago. I think this is the opportunity to go back in time and buy a company as high quality as Berkshire Hathaway, but 30 years ago. Yes, I know the world is different, but the investing principles that worked 30 years ago still work today. Now, if you haven't done so already, please subscribe so you don't miss my future videos about Markel. If you made it through all 4 videos, please leave me a comment so I know you got something out of it. This was a lot of work, so it'd be nice to know someone at least found it helpful. Thanks again, and I'll see you in the next video.